Good morning, everybody. Welcome. I'd like to call our meeting to order, please. And are there any public comments?
Yes, there is one public speaker, Mr. Henderson from PCAC.
Okay, would he please come forward?
Thank you. Good morning. Today I want to speak about the proposed contract between the MTA and Transport for London for expert services. Through the contract, the MTA proposes to access unique or otherwise outstanding knowledge and abilities that TfL may possess in the areas of transportation systems and operation. We believe that this procurement needs to be seen in context of a larger cooperative relationship between TfL and the MTA. It's an ambitious relationship and goes far beyond the occasional informal contacts that professionals have in transportation agencies. We believe the relationship's potentially very beneficial to both agencies, and we hope that there's going to be ample opportunities for collaboration, not only in regard to transit, but also in regard to commuter rail. There are few transportation agencies that can truly be considered peers of the MTA, and the potential for exchange of information, knowledge, and expertise is exciting. Still, the proposed procurement from this new relationship understandably raises some eyebrows. Under the current MTA procurement system, this is a sole source, non-competitive procurement for up to $1.5 million over 2 years. It should be noted that this proposed contract contemplates only the reimbursement of actual cost and not profit or overhead. We believe that the benefits of the contract, in terms of both cost and quality of services received, make the new direction worth pursuing, so long as there is appropriate monitoring of its progress. We recommend that MTA Audit Service have oversight of this contract, and after the first year of the contract term, present to the MTA Board and the public its conclusions as to the costs and benefits of the contract. These conclusions should address whether the MTA's needs are being met through the expert services arrangement and whether costs incurred in meeting those needs are favorable in comparison to the estimated cost of meeting those needs through other channels, such as private consultants. Thank you.
First order of business is approval of the minutes of our September 21st meeting. May I please have a motion? And a second, please? And a vote, please. Minutes are approved. Gary, would you take us through the work plan, please?
There are no changes to the work plan. The first item is Budget Watch, which Mr. Johnson will bring us through.
Hi, good morning. I'm going to talk about September flash results versus the mid-year forecast. Combined passenger revenues in September were slightly favorable, as higher revenues at New York City Transit were partially offset by the impact of lower ridership at Metro North. We've had similar results in June, July, and August, so it's sort of that trend seems to be carrying forward. Year-to-date passenger revenues are $9 million favorable on a year-to-date base, total MTA-wide. Toll revenue was $5.2 million, or 4.4% favorable for the month, which was a very good month. Year-to-date, that revenue is $13 million, or 1.4% favorable. Turning to operating expenses, they were favorable at all agencies. Combined expenses were $15 million favorable, or 2.3% for the month. Year-to-date, they were $91 million favorable, or 1.5%. Transit was $44 million, or 1% favorable. Long Island Railroad was $27 million, or 3% favorable. Metro North was $20 million, or 3% favorable. Now, a lot of that is timing. However, we are seeing some real savings, which will be reflected in the November plan, and those are in energy, materials, and maintenance contracts. Some of that timing will result in additional expenses next year, though. Debt service costs were favorable for the month and year-to-date, and most of that is timing. Some of that is from lower variable rates. Turning to subsidies, PBT taxes are on target with the mid-year forecast. Real estate taxes were disappointing, however, because through September, these receipts had been tracking to the mid-year forecast. October results, we received $30 million, which was $18 million or 38% below the forecast for the month. And we had been actually right at budget. Right now, on a year-to-date basis, we're unfavorable $21 million. The two main components of that, MRT receipts had been showing a steady but modest increase through the year. October showed a slight decline. They were 8% unfavorable. And the problem there is that was the first month since June where we had not had an improvement over the prior month. The urban tax collections were very poor in October. We only received $7.7 million for the month, one of the worst months we've had on record. That was an unfavorable variance of $16 million or 68%. So that's an area of concern for us, something we're looking at very closely. That and the agency results we're monitoring very closely right now, and in November we're going to have a revised financial plan, and it'll include a revised forecast for 2009. That's all I have right now.
Okay, Doug, thank you very much. Pardon me. Next item on our agenda is Finance Watch. Patrick?
Thank you. Finance Watch begins on page 13 of your committee book. We have a transaction to report on, which I know we sent you an email of the official statement. This is our $502 million Transportation Revenue Bond Issue 2009A. These series of bonds were broken into a taxable Build America component and a tax-exempt component. The taxable piece was $407 million, and the tax-exempt part was $95 million. That enabled us to achieve level debt service in the portfolio, which is our goal when we issue new debt. The Build America bonds, again, provide a 35% subsidy from the Treasury to the MTA on each interest payment date for the bonds for their life. Just to give you the costs here in the third paragraph, the TIC for those bonds was 3.79%, and the TIC for the tax-exempt part, which was inside of 10 years maturities, was 2.61%, combined 3.71%. So we felt this was a very attractive market to issue in. Citigroup was the book runner on the Build America bonds, and Ramirez and Company was the senior manager on the A2 bonds, and then Merrill Lynch and Company, they were a special co-senior on both series of the transaction. Later in our work plan, we're going to bring a resolution for the committee to consider, and this is related to an upcoming financing for Triborough Bridge and Tunnel Authority. This is a $150 million issue, which we need to have proceeds in the bank to deal with a January 20th maturity date on that mandatory tender bond that we issued earlier in the year. That's coming due, and this gives us the flexibility to either pay that off or, in effect, roll it and push out the maturity another year or two or three. And we're looking at the market conditions as we get closer to that maturity date to determine what the best course of action is. But having the band proceeds in hand gives us the most flexibility and the most options to work with. So that's Finance Watch. If there's any questions.
The next item on our agenda is MTA headquarters and all agency items. Patrick, you want to proceed then with the report on the derivatives portfolio?
Sure. On page 23 of your book is a set of slides designed to update the committee on and consistent with the work plan on our derivatives portfolio. I'm not going to go through every slide, just to give you a top-line summary what the update is designed to talk about. Here on page 1 of or 25 of the book, the large pie chart, we're focusing on this hedged variable rate piece of the pie, $3.1 billion, or 12% of our outstanding portfolio. The next two pages just provide an update on our, a recap, I should say, on our swap policy, which is in place since 2002. Turning the page, the mark-to-market on the swap portfolio by credit is shown on page 4. Notional amount of $4.2 billion, and the difference here between what we showed on the pie chart and what we're showing here is the fact that we do have a basis swap overlay, bless you, on some Triborough bonds that we issued in 2005. So just so we're clear on the amount of bonds are swapped is the $3 billion number. And here you see the mark-to-market as of September 30th, 2009 compared with the mark-to-market at September 30th, 2008. Our current aggregate mark-to-market is $431 million to the negative. That's a theoretical replacement value. If these transactions all imploded for whatever reason, that would be the amount that MTA and or TBTA would owe. That in and of itself should not concern the committee. The concern would come, obviously, as if our counterparties started to have difficulties, or if we had difficulties. Page 5 just summarizes terminations and so forth that we've engaged in over the years. On the left, terminations of interest rate locks. There's nothing new there, so that's kind of historical snapshot. On the right side, just a correction, the 3.703 million TBTA termination, that should actually be a negative, and that was done earlier this year. So our total negative terminations add up to about 13 million. Page 7 of this book gives you a breakout of swaps aggregated by counterparty, with the largest counterparty, UBS AG, on the top with a $1.6 billion notional, down to the smallest notional, Ambac Financial Services, a $77 million notional. It gives the ratings, the percent of the portfolio, the percent of the swap portfolio that firm has, and again, a recap of the total mark-to-market by firm. And then the last page of the report just gives you a further detail showing the bonds that are swapped, again, the par amount, the fixed rate paid, the type of swap that we're engaged in, and again, a recap of the mark-to-market. Happy to take any questions.
Does anybody have any questions? Gary, do you want to just jump in here?
Yeah, there's a couple of things I want to go through with the committee. Well, thank you, Pat. We're going to come back also on the action item. In terms of what we're looking at for next month, and then to discuss for a few minutes the things that are happening in Albany vis-a-vis the special session that the governor's called for, as well as the governor's budget deficit reduction plan. So in terms of what it is that we're watching, obviously we have a couple of things that we're most concerned about. When Doug went through Budget Watch, he talked a little bit about how while we remain tracking close to and positive to the budget, there's a couple of areas of concern that we need to keep our eye on carefully. Particularly, those are the real property transfer taxes in New York City, which have been performing poorly, and it could well be that we'll be talking to you in November about a revision of some of that portion of the forecast for the remainder of 2009, and then the impact it would have on the 2010 budget, which everybody remembers we were tight in 9 and tight in 10, but we remain in a positive cash position. I expect that will remain the same, but there'll be actions that we'll be talking about. With respect then to the other thing that we're really watching is the receipt of the state dedicated taxes that came about as a result of the Ravage Rescue Plan in the springtime. Those taxes have begun, and fees have begun to be collected up principally through the Tax and Finance Department in Albany. They are very slowly dribbling into the MTA's accounts in Albany that were set up as a result of legislation. Obviously, the watching that is critical to us because we are counting on more than $1 billion in receipts during the course of the remainder of the year. There's no reason to raise a flag with respect to it. It's just to understand that we haven't yet seen any of the proceeds, and we won't see them until next month. When we're here in November discussing the November plan, we will have a very good idea of how those proceeds are coming in, but as of right now, we don't. So it's simply to tee up and refresh your recollections that those proceeds are not visible to us yet. They're just beginning to be collected by state tax and finance. That's an important area, so we're obviously highly dependent upon that. To take that then to the next sort of logical part, which is the governor's deficit reduction program, let me just remind everyone that we, as part of getting us from A to B, where B is a budget, balanced budget, under our statutory requirements, we went into the marketplace and borrowed, I guess, $600 million on a revenue anticipation note, which is due at the end of the year, payments of which we will commence next month. The impact that the governor's proposed cuts has on both on the revenue anticipation note as well as our budget condition needs to be discussed for a second. So when the governor proposed, first of all, let me place it in context that everybody in this room is aware of, which is, the state is in, very dramatic budget situation. There is no question as to the level of difficulty that the state is facing. And in the governor's proposal, through a series of mechanisms, what they call a fund sweep, but basically where they go through and identify where are their account balances, then the state takes a proportion, depending on the different amounts, and has proposed to recover those portions. Now, the way that it works is because the funds have in them money that has already been appropriated as a result of the adopted budget. By law, those monies are set aside and then they are available to be drawn down by the receiving entities, whether it's a municipality or a city or in the case that we're most interested in today, the MTA. So there's a series of these are where various funds collect, and then they're appropriate and then we receive them. Part of the $600 million revenue anticipation note relates to these funds, as well as the new funds that are coming in from the payroll mobility tax and other taxes and fees passed in the springtime. The effect of the governor's proposal is to set up a discussion between the executive and the legislative branches about how to close this mid-year deficit and make a down payment on what next year's deficit for the state is. Those conversations are ongoing. We've been in communication with both the chamber as well as people in the legislature, and there's no point to me having any part of a discussion about whether I think one version or another version is going to pass. It's a highly unpredictable, and I would not use the word chaotic, but it is a highly unpredictable process, and I don't know what's going to come out as a result of the state action, other than to say to you that by definition, state action is what is necessary because these are amendments to appropriations that have already taken place. So in other words, there is no self-enforcing executive action that takes place. What takes place is the governor makes a proposal. It's actually a law, right, that would change an appropriation, and that appropriation then is either passed or not passed by the legislature and then signed or not signed by the governor. So the governor has called for, I think the governor is intending to call for special sessions later in November, during which this will be addressed in the event that he does call and they convene. Again, there's no way to predict what the outcome of that would be. So all of that said, then, what impact does it have on us? So in the event that the governor's proposal were adopted in its entirety, and again, this was part of a $5 billion proposal, our piece is about an easy number is about $115 million. We're distinguished from some other entities in a couple of particular ways. One is because of the way cash flows to the MTA from the state, in which we receive no money during the first quarter of the state's, the last quarter of the state's fiscal year, the first quarter of our fiscal year, remembering the overlap between us. We receive no money in January, February, and March from the state. So all of the state appropriation, under normal circumstances, takes place during our calendar, which is our during the calendar year, which is our fiscal year. Also, the state has delayed, for cash flow purposes, has delayed payment to us of our amounts in the MTOA accounts and other accounts. As a result, there are these fund balances which are then, available, in quotes, to be swept. That's where the roughly $115 million lies, and it lies in basically three different places. Right? One is the general fund money that's appropriated to the MTA. Two is the separate portion of the general fund appropriation which deals with school fare reimbursements. And third are the general MTOA tax receipts. So it is, and again, Ravage Rescue, there's basically no money in the Ravage Rescue accounts as of this instant. That's where the money is. In terms of the $115 million, then about 90 of it is earmarked from the MTOA accounts. So those are state-dedicated taxes that were intended for MTA's purposes, and that would be swept. And the remainder come from a reduction in the state general fund operating assistance. If you remember, the state has about $190 million in operating assistance that it grants to us under 18B. The vast bulk of that actually comes out of MTOA. There's a relatively small portion that comes from the state general fund, as in very small portion. There's also the amount associated with school fares, which the state did cut, but there's still $25 million, of which they're proposing the reduction in that as well. So that's the areas where the state is proposing to reduce us. What would happen if it happened? So let's talk about that for a second. Because we don't have any time in our fiscal year, because we don't run out until April, the entirety of the reduction, if it were to take place under the governor's schedule, would take place in the remainder of this calendar year. So it would take place sometime in the middle of November, and we would see immediately that amount of money, $115 million or so, would drop out of our budget in the calendar year that we're in. So we would have 6 weeks, in other words, for lack of a better term, to deal with it. Obviously, in 6 weeks, you would not have the ability to direct us as to what specific actions one would take to close a deficit of that size in that time period. So to place that in some perspective, not to be concerned. Obviously, the effect that would have would be we would have to cash manage our way through that problem. We obviously would make the payments to ensure that the RANs were paid back and make payroll and the rest. The actions that we would actually take in that event were to take place in the way that I just described would most likely be a cash management action where we would delay the payments of the same amount of money to the pension funds. And as a result, what would happen would be we would, by deferring, let's use $115 million as the number, by deferring $115 million in pension fund contributions that are due in December to immediately after the first of the year, we would incur some basically loan expenses, because when you borrow from your pension fund contribution, you have to pay back at the interest rate assumption, which is currently 8%. And so that's how we would cash manage our way through the problem. It's not to minimize it. It's a real issue. And I need to identify it to you that it is a real issue, and we need to understand it. But that's how it would be managed. It wouldn't be managed through other emergency actions that we would ask the board to take. So that's just an effort to quickly, sort of get the issue up so everybody kind of understands what's been proposed. Well, anybody have anything they want to ask me about that?
Yeah. If you're,
Go ahead, Jim.
if you're, you've taken us through the first quarter, but does the problem roll at that point, or are we talking about a timing issue that gets solved at the state level?
Right. Remember a couple of things. One is that the whatever cash effect happens that we cash manage, obviously we have to then reverse in the subsequent fiscal year. So that's thing one. Thing two, which is in some ways even more frightening than thing one, is that the actions that the state will need to take in order to maintain its fiscal house in order, because the state will have to take the actions that the governor proposed are very difficult. I know, they're mid-year school cuts, they're cuts to transportation, cuts to health, hospitals, aid to localities, the city. So they're dramatic and painful, but they are simply part of what would be coming in the next year, in the springtime, when the state goes through its normal budget process. Now, that's shaping up to be a pretty ugly-looking thing next spring over there. And it could affect us in any of various ways. The issue that's underneath all of that, right, is the issue of appropriation of state-dedicated taxes to the Metropolitan Transportation Authority. but for the existence of the appropriation process, this would be an interesting and important conversation, but it would be hemmed in by the amount of general fund subsidies that the state sends to us. That used to be a number in the $300 million range, many years ago. It's now, in its totality, less than $40 million. So the total amount that the state approaches to us through the general fund is less than $40 million from the general fund. The total appropriation exceeds $3 billion, the remainder being what comes to us from our state dedicated taxes. So when citizens of New York pay the MTA sales tax, when they pay the gas tax, when businesses pay the corporate surcharge of franchises, those monies are all collected and placed into either the DTF account or the petroleum business tax account or the MTOA, but they do flow through the state, and as a result of flowing through the state, they are subject to appropriation. Because they're subject to appropriation, then they're subject to risk of appropriation, which is what it is that we're seeing right now. But the general fund contribution that the state makes to us is, very modest. Like I said, less than $40 million right now. I'm sorry, Andy.
We've gotten indication, and as I'm sure you have, that some of the counties are trying to get out of the payroll tax obligation. Yeah, surprise. Is there a finite running period for this beyond which it sunsets, or is it ongoing until unappropriated?
No, the tax doesn't have a sunset. Presumably we'll be running a mass transit agency, and we'll continue to need subsidies from the tax sources from which we get them. So that when the taxes were enacted, there was no sunset. That was, again, we're talking now ravage rescue taxes. If those ravage rescue taxes did not have a sunset. Obviously there was a lot of debate about the impact of the payroll mobility tax on school districts, on localities. The MTA pays it itself. The only exemptions, other than very small threshold of being covered, the only exemptions were the federal government and other non-taxed entities like the international community in New York. So, the issue of sunset, doesn't exist. Obviously, any legislative enactment can be revised by subsequent, legislative action. I think Alan was. I'm sorry,
Yes.
Commissioner Capelli.
Yes, Gary, I'm sorry if you got into this before, but I got tied up and was a little late. What is the condition of the pre-ravage rescue taxes? And have they continued at the same decline, or have we seen any uptick in that?
Right. As we report on the bulk of those taxes, so they fall into two categories, MTOA and the DTF. The DTF we report on a monthly basis, and they're holding pretty stable. The MTOA accounts were appropriate, and those are pretty stable. And so although all of us are highly cognizant and sensitive to the risk of collections associated with our dedicated taxes, the issue of risk of appropriation is a slightly different one, and that's the one I've been focused on. Obviously, we know that we're subject to the risk of collection, and in fact, several $100 million in our 2009 budget is a reduction from what we received in 2008 as a result of the risk associated with collections. Economic activity slows or deteriorates in this case, and then obviously it impacts our economically sensitive taxes. That's reflected in our forecast, and that's reflected in what it is, and therefore other actions have to be taken, whether they are expenditure reductions or other revenues raised. In this case, a combination of both. So yes and yes.
Okay, the short answer to whether or not is the economy showing any signs, or has real estate activity picked up in any perceptible means since we last had this conversation?
Right. The taxes that we're talking about, that we have been talking about, actually don't include the real estate transfer taxes, which flow differently than the MTOA and DTFs. The real estate taxes, and I'm sorry, you did miss that because that's what Doug talked about a little bit. The real estate taxes have been performing on the mortgage recording taxes throughout the entire metropolitan commuter transportation district. Have been tracking pretty close to what we forecast in July. The urban tax associated with transactions in the commercial transactions in the 5 boroughs this month was very bad. And there is, look, there's a general sense. That's a highly complex set of economic features that controls urban tax receipts having to do with when commercial buildings, and again, much of this is Manhattan, when commercial buildings move. And it has to do with the tolerance level of the banks in terms of working out loans that are distressed. It has to do with what other actions commercial real estate holders can take to forestall a distress sale. When you see numbers that we're seeing, there's no distress sales in there, which would normally be unusual in where you see a downturn of the magnitude that we've seen them. So that means that there's something else happening underneath there, right? I think many of us understand what that is, but which is continuing to work out in the financial industry. But so that remains an area of great concern.
Thank you.
Yeah, I got Mark in there.
Just, I think that, when people start talking about the politics of the payroll tax and whether this is going to be somehow cut back or changed, built into the original deal was a state commitment to reimburse school districts in the state for their cost on the payroll tax. And that was actually supposed to happen in the first quarter of the state's fiscal year starting this April 1. So even without actually addressing questions of whether you're going to continue to impose the tax in the way it was laid out, there's already built in a considerable question in terms of that commitment to reimburse school districts statewide, which is a pretty large, or region-wide, it's a pretty large portion of the net collection of the payroll tax.
Although it was intended to be bulleted or reimbursement from state to districts, not in terms of collection.
Yes.
Is it coming out? It's not coming out of...
It doesn't come out of the tax, but it does come out of the state.
Yes.
And when you start looking at that, I mean, this question of how much of our money comes from the state general fund and how much comes from basically regional taxes in our region. If you figure the payroll tax comes out of the region, the school district reimbursement comes out of the general fund, it becomes very weird in terms of where the money's coming from and where it's going to.
Well, we know where it's going to. Or we know where it's supposed to go to, at least. Sometimes it gets lost on its way. But
Gary, you talked about some of the cash management actions and the tolerance level about $115 million. Let's assume everything falls. So the 115 plus the 20 million we were just talking about, plus I don't know what level they're short when the taxes finally do come in next month. What's your tolerance level for cash management that you can actually do?
Right, we did stress testing for the ratings agencies and for the investing community when we put the RANDs out, and it's at the hundreds of millions of dollars level. I mean, again, I don't think it's a. I don't want to leave anyone with the way we. If, for example, in the springtime, we frequently talked about cash because we had a long time of the year to go, and we were quite anxious about cash. And I don't think that's the issue right now. I don't. We have a substantial amount of tolerance within what I would consider to be reasonable of what could happen in the last couple of months.
So given all that, then what impact does this have, if it were to go through, does impact on future RANDs? I mean, will the rating agencies look and say, hey, look, we counted on this, it didn't come through, we built it enough, so we're fine on this time around. But certainly, does that increase the cost of the next time you want to go into the market?
Yeah, we spent some time. We spent some time over the last week talking with various people, including our FA. And obviously, we teed up the issue with the rating agencies when it took place. We actually had a deal that was had just closed, and so it was a material event. We had to. So we did have serious discussions at the time that the governor introduced or released his proposal. But we've also had fairly extensive back and forth with RFA and others in the community to try to get a sense of level of risk. And I think that, again, baked into the whole process is some level of risk associated with the risk of appropriation. On the other hand, there's a distinction here. This money these funds have been taxed on the MTA's behalf. They've been collected on the MTA's behalf. They live in an account, and they've already been appropriated. So it isn't like what we've seen in the past, where funds were collected beyond what it was that the appropriation, and so therefore account balances became evident. And for those of us who've been around, this has been an issue since the late 80s, right? I mean, for as long as I can remember, issues about balances appearing in the accounts, MTA balances appearing in the accounts, and then, sort of, being used for a different purpose. This is a little bit different. I'm not going to suggest it's not different, but again, the risk of appropriation is baked in, so.
Okay, so basically, I think where you really stand is it's a watch and see where we are. You got a problem, a potential problem. You don't know how bad the potential problem is going to be. We know the state is under tremendous stress right now, and we're going to have to see how this thing plays out. But there's no question, we always knew that this budget that Gary put together and the Finance Committee approved, sent to the board, was a tenuous budget that was very close. I mean, there was not a lot of leeway in this thing. And the other thing I think you have to see is how that mobility tax is collected, too, because it's been very confusing the way it's been sent out. I know in discussions with my accountant, he just happened to say there's a tremendous amount of confusion, and the paperwork was sent out late. I think you're going to find, and I don't know, I have no idea, that you may wind up with less of the tax collected on the mobility tax than you think, which could become the bigger issue for you, but we'll see. You'll see how it comes. I think you have to watch all these things very carefully, Gary, over the next 2 months. We need to have this
I agree
report.
about watching.
We need to have this report every month to the committee,
Yes.
like you did. And it was a very good report, and I know you will keep us up to date. And if there's anything that transpires that makes you to believe that we're not going to be where we think we're going to believe, the committee absolutely has to know about it, of course.
Right, I'm giving you this information in real time. This is as current as I know it. I don't have any indication right now. I want to make clear. I do not have any indication right now of the payroll mobility tax coming in below or under.
Right, I understand.
Okay, thanks.
But you'll just let us know where you stand. Okay, I think the next thing is, Gary, is the semi-annual investment report. Am I correct on that?
That's correct. That was just distributed to the committee. What I would suggest is that they be given an opportunity to review it, and if there's any questions, we deal with those next month.
It's not an action.
No, it's only a report.
Okay. Next thing, we have to go back to Pat McCoy because he needs authorization, pardon me, for a TBTA bond anticipation note sale.
Okay,
Pat.
right. There's a staff summary that's on page 33 of the committee book, followed by a 2009 general revenue bond anticipation note supplemental resolution and related bond resolution. What this is designed to do is to enable us to go into the market and issue a $150 million TBTA note with a maturity of no greater than 3 years, the proceeds of which would be deposited and available to be used to refund a mandatory tender bond due January 20th, 2010 that we issued earlier in the year. We had, in our long discussions with the rating agencies over that issue at the time, we agreed to have proceeds on hand in advance of that January 20th date so that we had the flexibility to look at the market conditions at that time and either extend the maturity and effectively roll that note from January 20th to some future date, or to simply pay it off. And so at this time, what we're seeking board authorization for is just enabling us to access the market to have those proceeds on hand, and then we would continue to evaluate the market and to determine what our course of action would be with respect to the put bond that's due on January 20th. The resolution also allows for the issuance of bonds to refund the ban. That's the way our underlying resolution is written, is that when we come with a standalone ban authorization, it must also come with the authority to issue the bonds to repay it at some point when it matures. So that's before the committee.
Okay, may we please have a motion? And a second, please? Yes, and wait, I think, Alan, did you have a question, too? Oh, okay, fine. Then go ahead, Mark.
Do you have a ballpark of your expected rate on this ban?
Yes, I mean, we would be looking for something in the 40 to 60 basis point range.
I mean, something that you haven't talked about here is the difference between short rates and long rates at the moment.
Yes.
That the short rates are really cheap.
Yes, I thank
And
you.
as we go into, I mean, I assume that you have the same problem the rest of us do, which is in the normal variable rate market, which has been how we've accessed short rates. I mean, that's fine, but you need bank credit support, and the market for bank credit support, or bond insurer credit support, dare I say it, is that you can't get it. So the bands have become this sort of another way of accessing what, at least at the moment, is extraordinarily inexpensive financing.
That's absolutely right, and I think it's worth pointing out that since this market dislocation really began well over a year ago, we have not added any incremental new variable rate debt to the portfolio. All of our new debt has been issued in long-term fixed rate mode, and that has shifted our portfolio to being more and more in fixed rate mode, and that's exactly what bands do, is allow us to access the attractive rates that are currently available in the short-term market.
Right, and that was the discussion when we did this deal a year ago, was to precisely that point.
Right.
Okay, so there's no further discussion. I believe we have a second. We need a vote, please. All in favor? Aye. Okay, we got you all.
Thank you.
Next order of business is, let me just see here, resolution to authorize the execution, filing, acceptance of federal funds. Gary, do you want to?
This is a standard annual resolution that we have to have approved. It enables us to just accept federal funds and to apply for them.
I don't think there's very much question that we're going to vote for this, so may we have a motion? And a second, please.
Second.
All in favor? Okay. Thank you, federal government. Right, next, under procurement, under the MTA headquarters, I've asked Gary to please speak on this London transport item that's on the procurement for the home office for the MTA headquarters. I just want to say it needs to be explained properly, and I've asked Gary to do it so there's no misconception. As far as I'm concerned, personally, I was concerned about it when I first heard about it. After looking at it and discussing with Gary, I am very comfortable with it, and I do feel it's the right thing, just as our speaker, I think it has to be watched, which I know we will do, but as our guest speaker here this morning said, I think this is a really interesting thing and could have a lot of benefits for both London and here, and this is a government organization, obviously, that we're making this agreement with. So, Gary, before we bring this for a vote, would you please talk about this London transport item?
Thank you, Mr. Chairman. Mr. Monheim is here in the back for any detailed questions that are beyond my ability, which are probably any. But let me just respond to the way Andrew addressed the issue. So, first of all, you have to look at both parts of the staff summary has an attached document. The staff summary itself, just remembering how it is that the business here works, the staff summary itself is the procurement aspect of this. That's what it is that needs actual board approval. Attached to the staff summary is the actual cooperative agreement between TfL, the entity, the Transport for London, the entity with which we are proposing to do business, and MTA. The structure of the cooperation agreement is really the substance of the discussion. The physicality, the staff summary about the procurement is simply the relationship, right? So what is the agreement? The agreement is between TfL and MTA to share expertise in a really sort of a unique and perhaps a little bit unusual, certainly unusual for us, way. In some ways, it's almost like a sister city approach that municipalities have entered into. New York City, for example, has sister city agreements with Tokyo where there have been exchanges back and forth. And here, as I think Mr. Henderson mentioned, and it's not that MTA is peerless, it's just that there are a few entities that are as large as and as complex as the MTA. TfL happens to be one of them. So here the proposed agreement would allow MTA and TfL to exchange on a cost basis expertise between the two entities. That's the cooperation agreement, and the agreement itself actually lays out where the parties anticipate that those types of cooperation could take place. An obvious example, and one that the new chairman has mentioned, has been in the successful implementation of smart card technology, what's called the Oyster card in London, and application of that those learning experiences into our experience. But there are a host of other areas where that kind of proficiency could exist on one side and shared with the transportation entity on the other. The procurement document actually asks for authorization on a sole source basis to enter into this agreement in an amount not to exceed $500,000, so that this transaction, so that any of these individual transactions can happen on a routine basis without need to come back every time it's over $20,000 back to the board. Hopefully, what will happen over time is a partnership, right, where there's an actual exchange back and forth, but there would be financial exchanging back and forth. It's not swapping. It's not like like schools would swap kids. This is a little different than that. So this is a financial transaction, and that's why there's an actual procurement that's associated with it. So, it's not summer abroad. It would actually be taking some people here for a couple of months at a time to bring their proficiency here. They would continue to be paid, assuming it's coming this way. They would continue to be paid by, in this case, TfL, and we would reimburse TfL. We would not pay the person who came. Vice versa, it would be the same way. Obviously, we think that if effective, it would be substantially cheaper, more efficacious in many ways than actually trying to buy that or purchase that expertise through third-party consultancies. So I think that part's kind of obvious. The potential for it working, I think, is obvious. And I understand the need to monitor it carefully. And I would just say that I think that you've got, your internal audit group here is very aggressive, and they report to Jim Sador, who's not here. But if he were here, he would tell you that as well. So, so that's basically the TF. And as I said, Mr. Monheim's available for any other questions you might have.
Are there any questions? Al?
No, this is simply expense. Now, that's not, let me say that. It's interesting that you say that, because everything is expensed. Now, that doesn't mean that there couldn't be a chargeback to the capital plan. Let's imagine that, for example, that the work that MTA wanted was appropriately chargeable to a capital project. It would be expensed and then charged back. So I don't know if you wanted it at that level of detail, but... No. Right.
Gary, we have other MTA headquarter procurements also, so would you just read them off and then we'll make the proposal?
So we have a total of 3 non-competitive procurements, including the one that Mr. DeLavison just brought us through. The other 2 are for George Kosh, Ph.D., for consulting services to advise on technology and telecommunication issues for the MTA and all agencies. And that's for $88,000. And the third is for Vanguard Integrity Professional Incorporated, and that's a multi-agency software maintenance renewal contract. The total of the 3 contracts is $755,460.
Okay. So may I have a motion, please? And a second, please? Before we have a vote, I think, Andrew, you want to...
Yeah, I would echo what Gary said about there being few transit systems in the world that are able to have such an exchange with ours that are as complex and as multifaceted. So from Finchley Road to Flatbush Avenue, this is a very good idea, I think.
And I think you got to watch it, just like our guest speaker said. I think it could be really good, or it could become something that's not so really good, and I'm sure we'll hear a lot about it as we go on. But it's certainly worth a try. I mean, with all the money we spend on a lot of other things, this one, in my opinion, could have some benefits. It's not a bad idea. So may we please have a vote, please? All in favor? Okay, thank you. Gary?
Just one addendum to Andrew's thoughts. It seems to me that, we might have done this or might not have in the past. We are obviously doing this because we've got a quarterback who's able to really guide this process very efficaciously, and that has got to be a plus on both sides of the Atlantic, and for that reason, I think we're going to really get our money's worth.
Gary,
Next, Metro North, go ahead.
No, we also have two competitive procurements
sorry.
for MTA headquarters. The first is Skyline Connections for $765,087.54, and that is to provide web-based contract compliance system for the MTA Office of Civil Rights. And the second is Practicing Law Institute, and that's an all-agency legal education courses.
Okay, a motion, please. Second, please. And a vote, please.
Metro North has two procurements, one non-competitive, one competitive. The total of the two is $22,188,000. The competitive is for Choice Distribution Incorporated, which is $21,888,000, and that's for hardware fastener program. And the non-competitive is the smaller of the two for $300,000 for Loram Maintenance of Way Incorporated, and that's for rail grinding services.
Okay, a motion, please. Second, please. Second? And a vote, please. Go ahead.
Long Island Railroad has two procurements totaling $2,420,000. Do you want to go through each of the procurements or just the total?
A motion, please. And a second, please. Okay. And a vote, please. Vote, please. Okay. The one thing interesting, though, in talking about this, there are a tremendous amount, I hope we're looking at that, joint procurements here between not only transit, Long Island Railroad, Metro North, and this is something that we've been working on for a long time. I think there's going to be a lot of savings here. I think in most cases, the feelings, the sentiment here with the operating divisions is this is a really good thing now, and we are doing a lot more joint procurements, which I think can only help save a lot of money for the MTA. So in seriousness, if you look, there's tons of them in here. And matter of fact, the majority of these that we're approving are joint procurements, which is a really good thing. Go ahead, Gary.
There are no items for Long Island Bus. There are no items for Bridges and Tunnels. There is one action item for New York City Transit, and that is for tariff changes for the B61, B62 three-leg transfer.
Excuse me. A motion, please. Second. And a vote, please. Next.
And New York City Transit also has one procurement for $1,015,000, and that is a non-competitive procurement for the purchase of non-inventory parts replacements.
Second, please. And a vote, please.
No items for MTA Bus. Capital Construction has one ratification totaling $1,396,000 for software system support and electronic security.
Motion, please. Second, please. And a vote, please. Done.
And there are no items for First Mutual. That concludes the agenda.
Right. And a motion, please, to adjourn our meeting. Second, please. And a vote, please. Thank you, everybody. As always.